Today's episode of Market Talk is brought to you in part by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions, bored of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And good afternoon. Welcome into Market Talk for this Friday, November 19th. Great to be with you once again. Thank you for joining us. I'm your host, Jesse Allen. Find us online, markettalkag.com. That is our home on the web, markettalkag.com. Market Talk produced by the American Ag Network. Thank you for joining us here today once again. Final day in Kansas City at the National Association of Farm Broadcasting Convention. It's been a great week here in Kansas City, talking with folks, fellow farm broadcasters, as well as folks throughout the entire agriculture industry, and much more. Plenty of things discussed here at NAFB in Kansas City. We're going to be sharing some of those stories and some of the news items here throughout the next couple of weeks on Market Talk. Well, yesterday I got to sit down with Kent Beadle from CHS Hedging late in the day just to kind of talk about the markets overall and their trends, and we're going to get to that here in a second. Just want to recap Friday's action. It was a fairly quiet trading day on the day today. We saw corn, beans slightly below unchanged, Chicago KC wheat slightly above, spring wheat was under pressure. We saw crude oil under pressure as well, and that was an effect on the market trade on the day, while the dollar was higher. So that all kind of combined to be a weight on the markets. Now, taking a look here at the cattle on feed report as well, that was released just a little bit ago. Cattle and calves on feed for the slaughter market in the U.S. for feedlots with capacity of 1,000 or more head. It totaled 11.9 million head on November 1st. The inventory was slightly below November 1st of last year. Placements in feedlots during October totaled 2.25 million head, 2% above 2020. Net placements were 2.19 million head. During October, placements of cattle and calves weighing less than 600 pounds was 575,000 head. 600 to 699 was 500,000 head. 700 to 799, that was 470,000 head. 800 to 899 pounds was 425,000 head. 900 to 999 pounds was 190,000 head. And 1,000 pounds and greater was 85,000 head. Marketings of fed cattle during October totaled 1.79 million head, 5% below 2020. Other disappearance totaled 59,000 head during October, 6% below 2020. So, taking a look at the numbers, the average estimate for on feed was 99.7%. The actual number came in at 100%. Placed in October, the average estimate 102.4. We came in at 102, and marketed in October, the average estimate 96.1%. We came in at 95%. Now that'll have an impact on Monday's cattle trade, but overall we were quiet on the day in cattle and hog futures ahead of that report. December live cattle 37 higher, 133.52. February up 45, 137.70. Feeder cattle January 45 lower, 160.92. March down 17 at 163.37. December hogs 135 lower, 73.75. And February hogs down 82 at 82.47. That's a recap of Friday's market trade action here on this Friday episode of Market Talk, November 19th. Jesse Allen with you here. And again, yesterday I sat down with Kent Beadle from CHS Hedging. We've talked to Kent a couple of times. He has a lot of great insight into the market trade, and we got his thoughts on the direction of these markets here moving forward into the holiday season and beyond. And here is our conversation with Kent Beadle from CHS Hedging on Market Talk. And joining us now here live at the NAFB convention in Kansas City, Missouri on Market Talk, we have Kent Beadle with CHS Hedging. Kent, it's great to catch up with you in person. How are you, sir? I'm
doing great, and I agree. Being together live is terrific.
It definitely is. It's always a good thing to get to talk face-to-face and talk the market trade. And Kent, we take a look at just the trade as of late, and I kind of want to start and just talk about the relationship between corn and soybeans here a little bit, because we got this talk of this fight for acres going into 2022, and we look at soybeans and corn and how they're kind of just they're working together. When one moves one way, the other's going with it, and vice versa in that fight for acres. And what do you make of this current relationship between corn and beans on the trade right now?
Well, it's been favoring corn, okay? It has been favoring corn, and I think the soybeans got lost in the shuffle here for a little while because everyone is looking at South America, going, geez, they're going to have a big crop, and, well, why do we really need many acres here in the United States? And all of the sudden, a couple of things happened. First of all, the marketplace started paying a little more attention to the amount of soybean oil that we're using for renewable diesel out on the West Coast, California, Oregon, Washington. And these are not federal mandates, so I think the marketplace was maybe a little either confused or just a little bit asleep at the wheel. But we are now using a lot of soybean oil, and we're burning it in trucks going up and down the West Coast. So that has been driving crush margins all year, and it put our meal prices at a bit of a, let's just call it a byproduct status, right? Mm-hmm. So when meal got cheap, it became very quickly the cheapest protein source for livestock in the world. At about the same time, we started running into a lysine shortage, and that essentially requires more meal in the ration. And meal is the cheapest protein source in the world, and all of a sudden, meal prices surge based on just normal supply and demand factors. And now you've got expensive oil because of renewable diesel. You've got more expensive meal because of a lysine shortage and good margins in hogs and in poultry. And all of a sudden, the bearish narrative in soybeans has changed a little bit. You've still got a lot of bears out there who believe that we're going to lose exports to the South Americans. But meanwhile, we continue to sell 1 million tons and ship, over 2 million tons a week, and a lot of it's going to China. And, I think with these higher prices, the Chinese are maybe taking a little bit of pause. But, if you look at Chinese prices, we would expect that we're going to have good Chinese demand here until that South American crop, comes to the market, and that's really not going to be till February.
Sure. And South American crop, I mean, they're well ahead of schedule in planting at an average pace. They're talking some dryness with La Nina, but you think about it with that crop in the ground. Unless it's a prolonged drought event, I mean, how much is that really going to affect them down there? And I think that's another factor we're watching as well.
Well, for sure. And, if there are going to be La Nina effects, we think they're going to be felt most prominently in southern Brazil. Mm-hmm. So you're talking Paraná, potentially Rio Grande do Sul, whereas, Mato Grosso is, really looking in pretty good shape. Of course, the other place we're watching is Argentina. Now, they've managed to get some reasonable amounts of rain here in the last week or two. But, again, if you do have La Nina effects, we would be worried about Argentina and what they might produce. And that kind of plays into the meal story because, let's face it, Argentina is the largest meal exporter in the world. If they don't have as large a crop and they export less meal, that provides another outlet for this additional domestic crush that we have that we're performing because of the strong oil values.
Another thing I want to talk about as well is that, and we were discussing this before we went on the air too, and this is something I've been noticing, we're kind of back to levels that we were early in the year, $6 corn, yep. $13 beans in some of these contracts, or we're nearing that, but it almost feels like that resistance, we're kind of, I'm going to call it the glass ceiling. We're kind of bumping up and hitting against it again.
Yep,
and one has to wonder, are we going to surge through that? And I think second part of that thought, one way maybe we could is if we continue to have supply chain issues and fertilizer and things of that nature. I wonder if that fight for acres and worries about supply chains, etc., if that's going to give us enough strength to push through some of that resistance.
Well, I look at it as supply chain and its impact on what farmers are able to, how much fertilizer they're able to use, how much chemical they're able to apply. You worry about things like lack of glyphosate and those types of things. Those could have an impact. I would think that those types of impacts would be more of a summer impact. For the winter here, you're exactly right. As we've been pushing up toward these recent highs, let's call it 585 East corn, and our highs here the last 2 days in beans, in that 1285 Jan beans. What that does is it takes the deferred contracts, deferred corn at $6, it takes the deferred beans at 13, and that's a number that an awful lot of growers just have some interest in selling. And so, yes, we've absolutely shook loose some bushels out of the country, and I think that's primarily the reason that we probably fell back today is just on some good old-fashioned head selling. What normally happens is that you take a few stabs at it, and if the underlying fundamentals are still good, you'll eventually get through it and you make another leg higher. I think that the potential drivers for that this year would be if our weekly export sales continue to be decent, and they were fine today. They were good numbers. And second, if there are any weather concerns that develop in South America, we'll certainly trade that. And then the third thing that I'm just going to keep watching is Chinese prices, right? Yeah. If Chinese prices hold in there, and if energy prices hang in there, and let's just call it a fourth factor, but strong Chinese demand plus strong energy prices means big margin, touching a bushel of corn, touching a bushel of beans, and that might be the thing that gets us up over through that resistance. But
and I think as well, strong cash prices too in the countryside is going to shake some bushels loose. I mean, I think about some ethanol plants were well over $6, on the cash side at some ethanol plants, just trying to shake loose some of those bushels from our growers. So I think that's another thing to pay attention to as well.
Absolutely, and watching those margins. And again, that's about the energy prices, right? So if we have 50 to 80 cent ethanol margins, if we continue to have $2 a bushel soybean crush margins, then the corrections, like the one we may have started today, are likely to be shallow, and the retests of the highs are likely to come.
We're talking with Kent Beadle with CHS Hedging here on Market Talk today. And Kent, the wheat market, we haven't touched on that yet. I know we've been really strong numbers in this wheat market, and new contract highs Thursday, Chicago, KC, Paris wheat, before we fell back in the bigger sell-off Thursday. But looking at overall at this wheat picture, the story really hasn't changed. The shortage of global quality milling wheat is there. It's got its own fundamental legs. A lot of bullishness in this wheat market, it feels like to me. And I think as well, as we look at the acre battle for 2022, I think a lot of those areas that traditionally grow wheat that maybe have shifted away from that in recent years, I think they're going to go back to wheat just with where the price levels are at.
Yeah, and that's, you talked about the corn-bean ratio, and as I said, it probably favors corn. However, that corn-bean ratio doesn't take into account for the cost of fertilizer. But when I look at that acreage fight next year, I have to think that wheat is going to, in fact, probably pull additional million acres into spring wheat in North Dakota and northwest Minnesota. Okay. And you also take a look at cotton prices, by the way, and that ought to, that could easily gain us 1 million acres of additional cotton in the south. And all of a sudden you're talking about a couple million acres that the corn and soybeans are now trying to either maintain, or if they're going to lose, well, now what are these numbers really going to be? In my balance sheet, I have 86.5 beans and 92 million corn, which is neither of those are as big as what I think the marketplace has been trying to price in, because I think you need the additional spring wheat acres and you need the additional cotton acres with the prices we have there.
Very, very true. Let's look at livestock a little bit before we run out of time. Weekly export sales, good for cattle. I mean, China bought about half of what we exported here for the week. On that cattle side, cash country, we've been, a couple dollars higher here, starting to get some good numbers there. But the futures market hasn't really felt like it's wanted to go along with cash yet. It just feels like it's waiting for something. Is that what you think?
Well, we actually had a breakout in the cattle futures today, and that strong cash finally, I think the futures market finally said, God, we can't ignore this anymore, right? And so we made some new highs. And, the cattle market is an interesting market because once you get the funds deciding that they want to own it, you get some pretty you'll get some pretty big money flow, and that can oftentimes be worth $3-5 because that marketplace is somewhat thin. And frankly, we're going to need to see the futures react if we continue to have the strong cash type trade that we saw today.
On the hog market, we got a supply in that hog market versus cattle, where we're trying to find more cattle here and put them through the system. On the flip side, we got a lot of pork in the system. We got a lot of hogs out there, and that seems to maybe be a factor that's depressing prices a little bit. What's your thoughts on the hog market as we near the end of the week?
Well, this is the time of the year when seasonally we end up having a little more supply for the marketplace, right? And rate of gain is generally better at this time of the year, and you're just with even if you don't have as many pigs, you're still you're putting larger pigs into the system, right? The last Hog and Pig Report was actually reasonably shocking in the fact that we didn't have as many pigs as we might have thought we had going into that report. And if you remember, we gapped higher and shot higher off of that report. And what happened? Well, you had still reasonably cheap corn, cheap meal, and you got expensive hog prices, and all of a sudden you had a lot of margin selling going on and a lot of hedging, and then the funds and the money came in and said, well, geez, it looks like we're not going up, so we're going to go down. I think the hog market got itself a little bit cheap. I'm obviously waiting for this next Hog and Pig Report to see if that loss of pigs that is something that follows through. Yes, there's plenty of pork. It's not like we're short pork, but we also have good, strong demand. I mean, if you look at that report, we sold a lot of pork to Mexico again this week. We continue to sell pork to China. We continue to sell pork to Canada. I'm still somewhat optimistic, and part of it is also my optimism about just domestic demand from the American consumer in protein.
As we look ahead here, we're getting into the holiday season, Thanksgiving, this next week, and obviously Christmas coming up, and this is typically a quieter time of the year in the market trade. Do you worry with that quiet trade that we have a little more volatility, or the chance for more volatility, especially, our foreign markets, they're open, they're not celebrating Thanksgiving. I mean, think about that a little bit. What are your thoughts as we enter into the holiday season, which is typically quiet? At
these more elevated prices, you are always going to have more volatile markets, right? As we talked, there's going to be some additional challenges of those resistance areas at 6 and 13. There's likely to be some corrective activity as well, just based on worries about South American production and the like, and I expect a kind of a range trade of let's call it $5.60 to $6 in the corn, and probably $12.40 to $13 in the beans. I don't think the market's going to go back down and test the harvest lows that we made in the low $5 corn, just underneath $12 beans. Just too much margin out there in the system right now.
Well, Kent, great stuff and analysis as always. And if producers need a little advice, I know they could reach out to you and the folks at CHS Hedging and get that advice, can't they?
Yeah. Our website is www.chshedging.com, and we can be reached on the phone at 800-328-6530.
Kent, it's great to see you in person, sir. Safe travels back home to the Twin Cities, and we'll talk again real soon.
Real soon. Thank you, Jesse.
And again, that's Kent Beadle with CHS Hedging joining us here for Market Talk. We got to talk with him after the trade talk portion of NAFB yesterday afternoon late and got his thoughts on the market trade. We thank him for joining us. That's going to do it for this Friday, November 19th edition of Market Talk, live from Kansas City. We'll be back in studio with you on Monday. Got a couple days next week before Thanksgiving hits us on Thursday. But we thank you so much for joining us, making us part of your day. MarketTalkAg.com, our home on the web. And again, I'm your host, Jesse Allen, wishing you a great afternoon and a great weekend. We'll talk to you Monday.